inflation is not going away. I don't care what anybody says or anybody thinks or what the media says. It ain't going anywhere.
Debate was last night as we sit here and record this. This will air in a month or so.
Yeah.
Do you think the election will have any impact whatsoever on the real estate market?
I think it definitely will. But I think, that's another thing. A lot of people, certainly a lot of entrepreneurs, are worried about who's in office or what interest rates are. I mean, you have to build a business that operates irregardless of that, right? So I was just talking to our buddy John on the way here and saying, because we were talking about it a little bit, and said, we could probably talk for an entire day on the politics of this stuff, right? It's like, well, the Democrats say they want to bring housing, make affordable housing, and we're also going to give you $25,000 to buy a house. It's like, that causes inflation. Like, that's why we're in this situation. We keep printing money and the inflation will never end, right? And so it sounds good. It's a soundbite to somebody that's broke and wants to buy a house. But the reality is housing prices are never coming down substantially.
Kevin O'Leary did a cool post about that. He goes, that just helps the sellers. It doesn't help the buyers because immediately prices will go up by $25,000.
It's the reason to just keep rentals. It's one of the reasons why I've kept all my rentals, even though they're a pain in the ass. It's like they're the best hedge that you could possibly have against inflation, And inflation is not going away. I don't care what anybody says or anybody thinks or what the media says. It ain't going anywhere.
And here, I'm going to be a nerd, but I'll try to use Tim Herridge marine language. So, rates go down, and all the Insta-gurus say that's going to make values skyrocket. Values skyrocket. One of the largest influencers of the CPI, the core inflation that the Fed decides on what they're going to do with rates is housing. So if housing does go way up, inflation goes way up.
Right.
Which then means what else goes up? Rates. We're going to see, man, I just guarantee you, rates, well, I'll just say this, the 30-year fixed on investment mortgages hit 5% again today. 5%. Now, it's a hard loan to get. Most of the rates are going to be in the high fives or low sixes.
Right.
But it's a lot better than the 9 we saw a year ago.
Yeah.
It's dang near half or 30% reduction. But here's what's going to happen. Rates will go down, demand goes up, prices go up, inflation goes up. Federal Reserve is worried about what happened in the 80s. They call it the Volcker effect, where they cut too quickly and then inflation re-ramped. So you're going to then see the next month rates go back up. And that's going to be the yin and the yang for the next 12 months. There's no world where we get back to 2 and 3% mortgages. There's no world where we don't have, where rates just all of a sudden go back down to the federal rate goes down to 3%. Rates will be higher for longer. I think there's a great temporary blip that people should take advantage of if they're stuck into some high-priced mortgages. But there is no silver bullet. Any manipulation like that is just going to artificially increase inflation, which will then, they meet every month. Then rates will go back up, they go back up. So, God, I'm a nerd. Right now, everybody thinks in September they'll go down 50 base, half a point. So that's already priced in. If they were only to go a quarter point, rates would go back up. If they actually went up in October, because see, they're already projecting that it keeps going down. If they actually had to go up in October or stay flat, you would see interest rates go up like a full point. So it's not simple. I don't think whoever wins matters. We are stuck in this cycle for the next 2 years.
It'll impact things. I mean, even with like Trump, I think we would see a boon to the economy, but I think the only way out of this mess is to completely destroy the dollar. Like, that's the only way out. And it might be decades, I don't know. I mean, it's been going on for decades and decades, right? So inflation is there's these periods where they kick the can down the road. It feels good. It's like a drug. It feels good for a while, but there's no way out besides destroying the dollar. And that's this is how the rich get richer. We own assets, you own real estate, you invest in the stock market, whatever it is. All that inflation just feeds prices on everything. And if you're living paycheck to paycheck, you're screwed. Those are the people that really get hosed. But if you own assets, you ride it out.
Well, I mean, to your point, like how the rich get richer, like when there is tragedy or devastation, I mean, look at COVID. It wiped out how many small businesses, yet
Yeah.
Amazon and Tesla and all these other
yeah.
giant corporations just got gianter, you know?
Yeah.
So,
Well, they have more staying power. I mean, that is back to your question earlier about entrepreneurs kind of getting, you didn't ask about that, but kind of getting stuck is once you build up some dry powder, like once you're living below your means or you're making enough money, you can sit on the sideline. You don't have to make money today to win, right? And so case in point, I've invested in a lot of multifamily over the last 8 or 10 years, 6 or 8 years, I guess. And it's had some performance problems. There's some issues going on, but there's opportunities coming too. Some people that I know that are in deals that I'm in want out, and I can replace their capital. And the way it works is you get a pref return on the front end, and on the back end, you get a piece of the profit. Contractually, they can't sell the deal, or the GPs will get wiped out until the LPs are made kind of whole. So there's deals right now. I just got presented with several deals, a couple deals that I'm in right now, where I can buy out. We're halfway through. We're 2.5, 3 years into this. People want their capital right now, and they give up the whole back end. So what does that mean for me? If it's like 10, if it's 8 and 10, well, they're going to give up their past 2.5 years of 10, and it's a 5-year project. So I can invest and earn 28%, completely passively on that. So I have patient capital at this point. And so there's opportunities like this as well.
You got any extra room in that for an old friend? Or?
Maybe.
All right,
Yeah.
I'm just saying.
Yeah.
I've never heard the term patient capital. I mean, I get it.
Like I don't need to make money today. Like
No, I
I'm
get it.
playing the long game.
I get it, but I love that terminology. I mean, I completely understand what you're saying, but it's
Yeah.
just like, that's so, yeah.
Well,
And
this
most
is
real
what
estate investors, they're thinking about
They
today.
need that.
Thinking about this week. They're thinking
Yeah,
about
they need
tomorrow.
that
They got to
hit.
pay the bills. And when you've been around for a while and you played the game long enough, you realize like, I don't need an immediate, in fact, that's the problem with most entrepreneurs. They want immediate gratification, and you need to delay gratification in order to be successful in business and in life, honestly.
And here's the thing that a lot of listeners don't know. They have patient capital, and it's in the equity of their homes. The equity in your homes is very patient capital. And in most situations right now, it is earning a 0 to negative return. And to me, that's neglect. Like if you have $1 million in equity on your balance sheet, that's an asset. But if that $1 million of equity is not producing a return, which appreciation's a return, but that's benchmarked against the negative of cash of taxes, the negative of insurance, the negative of your interest that you pay, not necessarily the principal you're paying, right? So you have to have a true financial picture, because you may be better off taking that $1 million out of those rent houses and getting in a deal like that, to where at least your equity is earning a return. In too many people, I'm glad you pointed that out, Ron. You have equity in the properties that you're invested in through other people. But you have to look at that equity as an asset. What is it producing right now? And that's what I told Jennifer. We have some rent houses that have gone up 3, 4, 5 times in value in the last couple of years. But right now, this year, that equity is not producing a return. And when I talk about liquidating it, I don't talk about then going and buying a Lambo. I don't talk about buying a $5 million house in University Park or Highland Park. I talk about finding an alternative investment that will get me the same tax advantages and a better return on my equity. Because here's the crazy thing. We're both in our mid-40s. We'll just say 45. If you're worth $1 million at 45 and you find a 20% IRR investment, you're worth $2 million at 50. If you do the same thing, now the key is this is why people exit. This is why Blackstone exits. You exit, you go find another 20% IRR deal. I actually recommend you take that $2 million and find 5 deals, put $500,000 each, that way you're diversified. But if you achieve a 20% IRR, you're worth $4 million at 55. If you do the same thing again, you're worth $8 million at 60. The key is at this point, you're not the operator. You're using patient capital to use someone else's energy to double your money every 5 years. That is the key to success, in my opinion.